Hi guys, I'm Nicola McKenzie, founder, mortgage and insurance specialist here at DM Mortgages. And in today's video, we'll be looking at some of the factors that lenders consider when they are evaluating mortgage applications. And I'm going to give you some tips to help you to put you in the best possible position to increase your chances of being approved for the best mortgage deals by telling you what lenders look for. So stay tuned to find out more. Now, before we get into the detail of today's video, guys, make sure that you subscribe to the channel, hit the notification bell if you haven't already, so that you never miss any property, mortgage and finance related videos. And I also want to ask you to consider using DM Mortgages to arrange your next mortgage or remortgage. Now, to do that, you can head over to our website, dm.mortgage, and there you can book in for a mortgage appointment with a member of our fully qualified mortgage advice team. Now, in today's video, guys, I'll be giving you some general tips that can encourage lenders to approve your mortgage application and or offer you lower interest rates, because it's essential to remember that when you apply for a mortgage, every lender's got its own criteria, guys. They've all got their own unique set of requirements. So just because one lender might approve you doesn't mean that they all will. It's very much based on individual circumstances. So in this video, what I'll be doing is really giving you just a general guide as to what factors will mean that more lenders might be willing to offer you a mortgage and open up better rates for you. Now, what I'm not suggesting in today's video is that if you don't fall into these categories, that it means you can't get a mortgage. So please just remember that I'm giving you general tips. But what it does mean is that if you don't fall into these categories, it might put you in a position where you've got less lenders to choose from, and or you might pay a slightly higher rate of interest, because like I say, a mortgage is based on individual circumstances. So this video is only here to give you a general guide. What I advise you to do once you've watched this video is book an appointment so that we can look at things based on you as an individual. Okay. Now, the first tip that I think you should follow to put yourself in the best chances of being approved for a mortgage, what lenders look for, is, and it sounds basic on the face of it, but people really underestimate how it's important that you fit the lender criteria. As I mentioned in the intro, every bank has its own criteria, and if you can understand the criteria of each lender, it's obviously going to increase your chance of acceptance, because it's going to allow you as the borrower to target specific lenders that align with your financial situation and the property that you're looking to buy. Now, like I said, every single bank has its own method of deciding whether or not they want to lend to you. If you fit the criteria, you might get accepted quickly. If you don't fit the lender criteria, then you're probably going to see that your application will decline, or certainly the chances of it declining will increase. Sometimes banks can overturn decisions, but it's not very often. Now, certain lenders may have stricter income requirements or credit score thresholds. Some lenders might have specific restrictions when it comes to even the type of properties. So for example, some high street banks will only lend to you if you're buying a flat if you've got a 15% deposit, whereas some will accept as little as a 5% deposit. And you could have the best credit score in the world, you could have the greatest income, you could be in a very sound financial position, but they still want a bigger deposit just by virtue of the fact that you're buying a flat over a house. And if you can understand these restrictions, then of course it's going to mean that as a borrower, you're not wasting time on applications that won't be accepted. Now, it goes without saying, guys, that a good mortgage broker can be absolutely invaluable, worth their weight in gold in helping you to navigate the complexities of mortgage criteria, because it's something that, you know, a lot of our team have been doing mortgages for 30, even 40 years in some cases. We know the lenders inside and out, and that means that we're in a much better position to match you as the borrower to the most suitable lender for your situation. When you go it alone, unless you've been working with mortgages for many, many years, then again, it's highly unlikely that you're going to have the knowledge and experience to select the right lender for your situation. Now, the next tip that I want to give you guys to put you in the best chance of being accepted for a mortgage is to make sure that you've got a stable employment history or income. So by having a stable employment status and a reliable income, it's indicating to a potential lender that you have the ability to meet your mortgage repayments consistently. So when I say stable employment, because again, everyone's idea of stable employment can vary, but I'm talking about here a permanent role in terms of employment. Now, it's a myth that in most cases you have to be in a new job for 6 months or more. That's just not how lenders nowadays work. Lenders understand that, jobs, generally speaking, a lot of people do move jobs every few years. So there are a lot of lenders that are relaxed in terms of how long they expect you to be in the job. And some lenders might even take a future job offer. But the point is, having a permanent role is a demonstration of stable income and stable employment. Now, what I'm not saying here is that you have to have a permanent role for a lender to see that you've got stable income and employment. And that's what brings me on to the next point. So if you are a contract worker, agency, 0 hours, that kind of thing, then most lenders will want you to demonstrate that you've got at least 12 months history in that type of work. Again, if you've got 12 months history or more, then a lot of lenders will consider that as good as you have in a permanent role. But you're going to find it very, very difficult if you've just taken on a contract, you've never done contract work before, and you've been in that contract work for only a month, for example. A lot of lenders aren't going to see that as demonstration that you've got a stable employment history. So that's going to make things more difficult. So generally speaking, if you're a contractor, then a lot of lenders will want you to have 12 months or more. Again, that rule doesn't always apply, because if you're coming from an industry, if you're an IT contractor, but you've been an IT specialist prior to that for many years and you're experienced in that sector, again, some lenders might be more relaxed. I'm just generalising here. Now, if you're self-employed, then the way that you demonstrate that you've got stable income is by most lenders demonstrating that you've got at least 2 years history as a self-employed person. Again, often we do get people come to us that say, I've just set up a business a few months ago. You're not going to get a mortgage if you've just set up a business 2 months ago. A lender is not going to see that that is mitigating their risk, in terms of the majority of businesses fail in the first 12 months. So why would a lender lend you £200,000 when you've only been self-employed for a few months? It's just not realistic, is it? So self-employed, most lenders will want a couple of years, and they'll ask you to demonstrate SA 302s or company accounts usually. Again, there are some lenders that will accept a minimum of 1 year's self-employment history, but the majority will want 2. Some will even want 3. Now, a few tips here. Being on the electoral roll, that's going to help you, because what it does is proves that you are who you say you are, and it's just going to enhance your credibility as a borrower. Okay. Now, it's going to give lenders confidence that you're a legitimate applicant and that you've got a stable living situation. Again, that's something that lenders like to see. They also like to see that you're managing your credit wisely. They also like to see that you're maintaining low credit utilisation. So credit utilisation is the amount of available credit that you are utilising. So for example, if you've got a credit card that's got a £1,000 limit on it and you've got a £250 balance, that would be 25% of that potential credit that you're utilising, and that would send a good signal to a lender that you can manage your finances responsibly and that you're not overspending. Again, if you're maxing out every bit of available credit you've got, that doesn't give a lender confidence that you're able to manage your finances wisely. Now, lenders also like to see that you are consistently paying your bills on time. It shows that you're disciplined and you're reliable as a borrower. Lenders want to see that you're making timely payments to your creditors, because it gives them a positive indication of how you're likely to manage these mortgage payments. Now, so many people, guys, so many of our clients sometimes really underestimate how much of an impact even just missing a £20 electricity bill can have on you. Where you've got missed payments, some lenders will not want to give you a mortgage because it can have a big impact in terms of, sometimes people say to us, well, it's only a £20 electricity bill, it's only £20. But from a lender's perspective, they're thinking, well, if you can't pay that on time, what gives us, we don't have the confidence that you're going to be able to manage £1,000 payment on time. So I hope you can kind of see where they're coming from here. Now, again, I'm not talking all lenders. We do manage to find mortgages for a lot of applicants that have poor credit history, that do have defaults, that do have CCJs, that do have bankruptcies. But missing payments on your creditors is going to make it more difficult. And again, the penalty you may have to pay is a higher rate of interest and less lenders are available to you. So make sure you're keeping up with your payments, and even the small list of outgoings and credit commitments, you pay them on time. Ideally as well, you don't want any CCJs, defaults, IVAs, bankruptcies. Again, it's possible to get a mortgage with those things, but it makes it harder, and that's not something that lenders generally like to see. Now, something else that lenders like to see is that you've got a low amount of committed expenditure. Now, discretionary spending. So discretionary spending is things that you could stop paying if the going gets tough, if you see what I mean. Now, with discretionary spending, lenders, again, don't like to see you necessarily going crazy every month. Not all lenders are going to scrutinise bank statements as much as others. But again, as long as you're living within your means, it doesn't mean, again, sometimes we meet people that, think that they have to stop going out and stop eating out and stop buying a single item of clothing. That's not what lenders expect. What they do just expect, though, is that, and it's all relative as well. If you're earning a good income, to be spending a lot of that isn't an issue. But again, just make sure that it's within your means. But when we're talking about low committed expenditure, these are things like credit cards, loans, childcare costs, that kind of thing. These are not things that people can just decide not to pay in the event that they get into financial difficulties. That's what's considered committed expenditure. So lenders do like to see that your committed expenditure is low. Again, though, bear in mind it's all relative. So when I say is low in relation to your income. Again, if you've got a loan for £500 a month and you're only earning £20,000 a year, that's going to affect you a lot more than if you're earning £100,000. Having a loan of £500 a month isn't possibly even going to have any impact at all. So it's all relative, but generally speaking, lenders like to see that you've got low committed expenditure. Okay. Now, another thing that lenders like to see is a good sized deposit. So a larger deposit shows lenders that, again, you as the borrower are willing to invest more in the property purchase, and therefore that reduces their risk as a lender. It also means that as the borrower, the bigger you deposit, more likely you are eligible for lower rates of interest. So it's going to make the mortgage more affordable in the long run, and it also means that you'll pay back less interest. So obviously that's a benefit. Now, it's common knowledge that mortgage rates tend to be more favourable specific to the loan to value percentages. So loan to value, just to recap, is the percentage, exactly what it says, the percentage of the loan in comparison to the value of the property. So if you've got a 10% deposit, your loan to value is 90%. If you've got a 20% deposit, your loan to value is 80%. So for example, an 80% mortgage and a 20% deposit is usually going to attract better interest rates compared to if you took out a mortgage for 81% with a 19% deposit. So again, just by increasing your deposit size in that example by a small 1%, that could be the difference between looking more favourable to a lender and not. So guys, what I'm trying to say here is that by pushing beyond the threshold, so by thresholds I'm talking about 95% loan to value, then 90%, 85%, 80%, so on and so forth, then it can give you potential benefits. It can increase your chances of getting a mortgage approved by going beyond the thresholds, because again, it shows to lenders that you've got that bigger deposit, you're in that next bracket of different products, because the products do change depending on what loan to value threshold you're in, and it can make you look more attractive as a borrower. It can also mean that you might be eligible for a higher mortgage amount. So some lenders might be willing to offer you a higher mortgage, for example, 4.75 times your income instead of the typical 4.5 times your income if you exceed the threshold. So some lenders do get more generous with their affordability, again, if you are able to get into the next threshold in terms of loan to value. Now, what that threshold trigger is going to vary depending on the lender. Not all lenders do that, but again, that is something to bear in mind. It makes you look more attractive to lenders, generally speaking, the bigger your deposit. It's also worth me mentioning, guys, that certainly where credit scoring is concerned, it can make quite a significant difference, especially when you're in the high loan to value thresholds. So if you're looking at 95% loan to value or 90% loan to value. When you're dealing with some of the lenders, their computer algorithms, let's say that your credit report is borderline, you know, you're not excellent on the credit scoring, you may be good or fair, then that can again be the difference between you getting accepted for a mortgage and not, because some lenders might accept you at 90% loan to value but not at 95% based on your credit scoring. Now, in summary, guys, to test your mortgage chances, I would recommend that when you're at the point where you are about to start viewing properties, you get an agreement in principle. An agreement in principle is going to show estate agents and sellers that you're a credible and a serious buyer. It's going to show that you've been pre-approved for a mortgage. It makes you look more attractive when you're going out and viewing properties. But also, it's going to help you to know as the borrower if you are able to get a mortgage and what that mortgage might potentially look like. So to look at your options and to get an agreement in principle, because we're happy to provide an agreement in principle to anyone that books in for an appointment free of charge, then head over to our website, which is dm.mortgage, and there you can book in for a free mortgage appointment with a member of our fully qualified mortgage advice team. And we look at lots of different lenders, from high street to specialist lenders, to compare your mortgage options and make sure that you're getting the best deal for your circumstances, but also give you advice on what changes you might need to make in your circumstances to put you in the best position to get that mortgage approved. So I hope that video has been useful. If it has, then hit the subscribe button and the notification bell so that you never miss any future video uploads, and I look forward to seeing you in the next video.